What if everything you've been told about investing is backwards? What if retiring early doesn't require dozens of stocks, constant trading, or endless stress, but instead a calm commitment to just a few extraordinary decisions? Most people spend their lives running in financial circles. They chase the next hot idea, the next trend, the next shortcut. They believe safety comes from owning more and more. But in reality, confusion grows with every extra decision. And confusion is expensive. Today, you're about to hear a different way of thinking, one that challenges noise, rewards patience, and proves that freedom doesn't come from doing more, but from doing less better. Stay with this until the end, because this isn't about stocks. It's about how early freedom is quietly built. The idea is simple but not easy. You don't need many great opportunities in life. You need a few, recognized clearly and held with conviction. Wealth doesn't come from being busy. It comes from being right and patient. Most portfolios fail not because of bad markets, but because of bad behavior. Too many holdings create false comfort. People call it diversification, but often it's just disguised uncertainty. When you don't truly understand what you own, fear shows up at the worst time, and fear leads to selling when patience is required most. Now imagine the opposite. Imagine owning just 3 outstanding businesses, each with durable advantages, honest leadership, and the ability to grow steadily over time. Businesses so strong that even during downturns, their foundations remain intact. When you understand them deeply, market swings stop feeling like threats and start looking like background noise. With focus comes clarity. With clarity comes confidence. And with confidence comes the ability to hold. Holding is where the real magic happens. Time doesn't reward constant action, it rewards consistency. Compounding doesn't need excitement, it needs endurance. The longer a great business works for you, the less you need to work for money. Early retirement isn't about predicting the future. It's about positioning yourself so that time does the heavy lifting. When capital is placed into a few powerful engines and left undisturbed, growth becomes inevitable rather than hopeful. But this approach demands discipline. Fewer choices mean nowhere to hide. You must be willing to say no again and again to distractions. You must resist the urge to tinker, to compare, to panic. Simplicity looks boring, but boredom is often the price of brilliance. Owning 3 great businesses doesn't mean ignoring risk. It means understanding it. Real risk isn't volatility. Real risk is permanent loss caused by ignorance or impatience. When you know exactly what you own and why you own it, short-term fear loses its power. Most people underestimate how far a few correct decisions can take them. They think success requires constant genius. It doesn't. It requires avoiding obvious mistakes, staying rational under pressure, and letting time compound effort quietly. Early freedom belongs to those who can wait, to those who don't confuse motion with progress, to those who trust quality over quantity. You don't need to own everything. You don't need to chase everything. You only need a few things that are truly exceptional and the courage to hold them long enough for patience to turn into independence. That's how simplicity becomes strength. That's how focus becomes freedom. And that's how early retirement stops being a dream and starts becoming inevitable. Concentration beats complexity because success in investing has never been about how many things you own, but how well you understand what you own. Most people believe that safety comes from spreading money across dozens of choices, yet what often follows is confusion, emotional decision-making, and weak conviction. When attention is divided across too many holdings, none receive the depth of thought they deserve. The result is a portfolio built on surface-level knowledge rather than true understanding. Extraordinary outcomes rarely come from average decisions repeated many times. They come from a small number of decisions made with clarity and held with patience. Owning a few exceptional businesses forces a higher standard of thinking. It demands discipline, research, and honest judgment. You cannot hide behind numbers when your choices are limited. Each decision must be strong enough to justify its place. This process naturally filters out mediocrity and distractions. Instead of reacting to headlines or market noise, focus shifts to long-term fundamentals, competitive strength, and the ability of a business to endure. Concentration rewards those who think deeply rather than widely. Complexity often feels sophisticated, but sophistication is not the same as wisdom. A crowded portfolio may look impressive, yet it usually reflects uncertainty rather than insight. Many average holdings tend to cancel each other out, producing ordinary results while increasing stress and oversight. Managing too much invites constant monitoring, frequent adjustments, and emotional fatigue. Simplicity, on the other hand, creates calm. When choices are few, the mind is clearer, decisions are slower, and actions are more deliberate. A concentrated approach aligns naturally with patience. Exceptional businesses do not reveal their full value overnight. Their true power emerges over years as reinvestment, discipline, and steady growth compound quietly. When focus is limited to a few high-quality assets, it becomes easier to ignore short-term fluctuations. Price movements lose their emotional grip because conviction is rooted in understanding, not hope. Time becomes an ally rather than a source of anxiety. Average businesses require constant attention because their advantages are fragile. They depend heavily on favorable conditions and external momentum. Exceptional businesses, however, are built to withstand pressure. Their strength lies in durable advantages, strong culture, and the ability to adapt. Owning fewer of these allows for deeper trust in their resilience. This trust reduces unnecessary action, which is often the greatest enemy of long-term success. Concentration also sharpens accountability. When results improve, the reason is clear. When mistakes occur, they are impossible to ignore. This feedback loop strengthens judgment over time. Complexity hides errors, allowing poor decisions to blend into the background. Simplicity exposes truth. It teaches humility, reinforces learning, and improves future decisions. Growth comes not just from returns, but from the refinement of thinking. Many people confuse diversification with risk reduction, yet risk is not the number of holdings. Risk is owning things you do not understand. True safety comes from clarity, not quantity. A small collection of well-understood, high-quality businesses can be far less risky than a large collection of unknowns. Knowledge reduces fear, and reduced fear leads to better behavior during uncertainty. Concentration demands courage. It requires the strength to be different, to resist popular opinion, and to remain steady when others are restless. But it also offers freedom. Fewer decisions mean fewer distractions, fewer emotional swings, and fewer regrets. Over time, the extraordinary results produced by focused ownership prove that complexity was never a requirement for success, only a distraction from it. Quality reduces risk, because risk does not come from owning too little, it comes from owning things blindly. Many people believe that spreading money across countless holdings automatically makes them safer. But safety built on ignorance is fragile. When investments are chosen without deep understanding, diversification becomes a false shield. It creates the illusion of protection while quietly increasing vulnerability. Real security is not found in numbers but in knowledge. Fewer holdings, chosen wisely, demand a higher level of thinking. Each choice must earn its place through strength, durability, and clarity. This process naturally lowers risk because weak ideas are filtered out early. When you understand how a business makes money, why customers remain loyal, and what protects it from competition, uncertainty shrinks. Risk fades not because prices stop moving, but because the foundation is solid. Widespread diversification often leads to shallow confidence. People own many things, yet cannot explain any of them clearly. In moments of stress, this lack of understanding turns into panic. Decisions are then driven by fear instead of reason. Selling happens at the worst possible time, not because the business is broken, but because conviction was never present. Quality ownership prevents this reaction by replacing fear with insight. High-quality businesses are designed to survive. They generate consistent cash, adapt to change, and maintain relevance over time. Their strength allows them to endure economic slowdowns, competitive pressure, and shifting trends. Owning fewer of these reduces the need for constant adjustment. Stability replaces anxiety. When quality is present, volatility becomes noise rather than danger. Risk is often confused with volatility, but they are not the same. Prices move daily for reasons that have little to do with long-term value. True risk is the permanent loss of capital caused by poor judgment or weak fundamentals. Quality reduces this risk by building a margin of safety into every decision. Strong businesses recover, weak ones disappear. Understanding this difference transforms how uncertainty is perceived. Choosing quality also improves behavior. When you trust what you own, patience becomes easier. You are less tempted to react, compare, or chase. Fewer holdings mean fewer emotional triggers. This calm approach protects capital more effectively than any complex strategy. Most losses are not caused by markets, but by emotional mistakes made under pressure. Quality requires discipline. It means waiting for the right opportunity rather than settling for what is available. It means saying no more often than yes. This selectiveness itself is a form of risk management. By avoiding mediocre choices, capital is preserved for stronger ones. Over time, this careful allocation compounds into resilience. In the end, safety is not about owning everything. It is about understanding something deeply. When investments are few, clear, and chosen for strength rather than convenience, risk shrinks naturally. Quality does not eliminate uncertainty, but it ensures that uncertainty is faced with confidence instead of fear. Time is the real multiplier because no amount of intelligence, speed, or activity can replace what patience quietly achieves. Many people search for growth through constant movement, believing that faster decisions produce faster results. In reality, lasting wealth is rarely created in bursts. It is built slowly, through years of steady progress that compound beyond expectations. Great businesses do not reveal their full power in months, but in decades. Patience allows quality to express itself. Strong businesses grow through reinvestment, efficiency, and learning. Each year builds upon the last, creating momentum that is invisible in the short term but overwhelming in the long term. When allowed to operate without interruption, this compounding effect transforms ordinary capital into something extraordinary. Time gives growth the space it needs to mature. Most people interrupt compounding before it can do its work. They sell too early, switch too often, and react to temporary discomfort. These actions reset the process repeatedly, turning long-term potential into short-term noise. Patience, on the other hand, keeps the engine running. It accepts short-term uncertainty in exchange for long-term certainty. This trade is where true wealth is formed. Great businesses become retirement engines not because they are exciting, but because they are consistent. They generate cash, reinvest wisely, and expand their reach gradually. Over time, small improvements accumulate into massive results. What begins as modest growth eventually becomes self-sustaining momentum. Time converts stability into freedom. The power of time is often underestimated because its early stages look unimpressive. Progress feels slow, almost invisible. But compounding is not linear. It accelerates. The later years produce more value than all the earlier ones combined. Those who remain patient long enough experience this shift. Those who leave early never see it. Patience also reduces mistakes. When time is respected, decisions become calmer and more thoughtful. There is less urgency to act and less temptation to chase. This restraint protects capital from emotional errors. Time rewards those who can wait and punishes those who cannot. True retirement freedom is not achieved through perfect timing, but through sufficient time. Starting early, staying invested, and resisting interruption allow compounding to do what no strategy can replicate. The real advantage is not predicting outcomes, but remaining present long enough to benefit from them. In the end, time does not need brilliance to work. It needs discipline. When patience is applied to great businesses, growth becomes inevitable. What once seemed slow becomes unstoppable, turning steady ownership into lasting independence. Simplicity creates discipline because the human mind performs best when it is not overwhelmed. Every additional decision drains focus, increases emotional pressure, and raises the chance of error. When choices are reduced, clarity improves. With clarity comes control. Fewer decisions mean energy is directed toward thinking deeply rather than reacting constantly. This mental calm is the foundation of disciplined behavior. Complex systems invite impulsive actions. When too many variables are in play, it becomes easy to justify poor choices. Conflicting signals create doubt, and doubt leads to hesitation or overreaction. Simplicity removes this noise. It strips the process down to what truly matters. By focusing on a limited number of well-understood positions, decisions become intentional rather than emotional. Discipline thrives when rules are easy to follow. A simple approach makes consistency possible. When actions are repeatable and clear, there is less temptation to break the process during moments of fear or excitement. This steadiness protects capital and preserves confidence. Mistakes often occur not from lack of knowledge, but from abandoning discipline under pressure. Fewer decisions also strengthen conviction. When choices are limited, each one is chosen carefully. Deep understanding replaces surface-level confidence. This depth allows investors to stay committed during difficult periods. Temporary declines no longer feel like personal failures, but normal phases in a long journey. Conviction rooted in simplicity is harder to shake. Simplicity encourages patience. When there is less to monitor, there is less urgency to act. This reduces unnecessary trading and emotional responses to short-term fluctuations. Time is allowed to work without interference. Discipline is maintained not through force but through structure. Simplicity provides that structure. Many errors come from overthinking rather than underthinking. Too much information creates paralysis or reckless action. A simple framework filters out distractions and highlights what is important. This focus leads to better judgment and fewer regrets. Each decision becomes a reflection of long-term intent rather than short-term emotion. Strong conviction built on simplicity creates resilience. When challenges arise, there is no confusion about why a decision was made. This clarity prevents panic and reinforces discipline. Over time, this approach compounds not only returns but confidence. Simplicity is not weakness. It is strength refined. By reducing decisions, discipline becomes natural. Fewer mistakes follow, and conviction grows steadily, supporting long-term success with calm and consistency. Understanding matters more than activity because movement without purpose creates the illusion of progress while quietly increasing risk. Many people believe that frequent action is a sign of intelligence and control, yet most activity is driven by emotion rather than insight. Buying and selling repeatedly may feel productive, but without clear understanding, it often leads to poor timing, higher costs, and unnecessary stress. True progress comes from knowing, not from constant doing. When you understand why you own something, patience becomes natural. Decisions are anchored in reasoning rather than headlines. Short-term price changes lose their power because they do not alter the underlying logic. This clarity creates stability during uncertainty. Activity fades, but confidence grows. Understanding replaces urgency with calm. Constant trading is often a response to discomfort. When conviction is weak, action becomes a way to regain control. Unfortunately, this behavior usually locks in mistakes rather than correcting them. Each transaction introduces friction, emotion, and the possibility of error. Over time, this drains both capital and confidence. Understanding eliminates the need for this cycle by providing a steady foundation. Knowing why you own something means understanding how it creates value, what could threaten it, and what conditions would justify change. This depth transforms decision-making. Instead of reacting to noise, actions are guided by clear criteria. Selling becomes a thoughtful choice rather than a reflex. Buying becomes deliberate rather than impulsive. Activity also distracts from long-term goals. Frequent changes shift focus from growth to performance monitoring. This short-term mindset undermines the benefits of compounding. Understanding encourages long-term ownership, allowing time to amplify results. The less you interfere, the more powerful the outcome becomes. A calm portfolio reflects a clear mind. Fewer actions mean fewer emotional highs and lows. Energy is preserved for thinking, learning, and improving judgment. This mental advantage compounds alongside financial returns. Most success comes not from doing more, but from doing less with greater clarity. Understanding builds conviction, and conviction reduces the need for action. When ownership is based on logic rather than hope, there is no pressure to respond to every fluctuation. Stability replaces anxiety. Over time, this approach proves that insight outperforms activity and thoughtful ownership outlasts constant movement. Wealth is built by holding because value needs time to grow into its full potential. Jumping from one opportunity to another may feel exciting, but excitement is rarely a reliable path to lasting success. Constant hopping breaks the chain of compounding. Each exit resets progress, turning what could have been exponential growth into a series of unfinished beginnings. Long-term ownership allows effort, capital, and time to work together. Holding requires emotional strength. Markets move, opinions change, and doubt appears regularly. Those who remain calm during these moments gain an advantage that cannot be taught through formulas. A steady mind resists the urge to react. Instead of chasing what is rising or fleeing what is falling, calm ownership stays focused on long-term value. This discipline separates builders from gamblers. Impatience is costly because it demands immediate results from a process that rewards waiting. Many people abandon strong positions simply because progress feels slow. They confuse temporary stagnation with failure. In doing so, they often leave just before momentum accelerates. Holding through quiet periods is uncomfortable, but it is during these periods that compounding quietly prepares its greatest rewards. Long-term ownership benefits from learning curves that cannot be rushed. Businesses improve through experience, reinvestment, and adaptation. These advantages accumulate gradually. By holding, you benefit from internal growth that cannot be replicated through frequent switching. Time amplifies quality, but only for those who stay present. Hopping introduces friction at every step. Costs, taxes, and emotional fatigue erode gains. Each move also increases the chance of poor timing, as decisions are often influenced by recent performance rather than future potential. Holding reduces these losses by minimizing unnecessary action. Fewer moves mean fewer opportunities to make mistakes. Calm minds are rewarded because they allow rational thinking to dominate emotional impulses. When fear and excitement are kept in check, decisions align with long-term goals. This stability builds resilience. Over time, calm ownership transforms volatility from a threat into a test of discipline. Impatience, on the other hand, demands certainty in an uncertain world. It seeks control where none exists. This mindset leads to overreaction and regret. Wealth does not grow in such conditions. It grows where patience is allowed to mature. Holding is not about stubbornness. It is about trust in understanding and time. When conviction is grounded in clarity, holding becomes easier. Long-term ownership then does what impatience never can. It turns steady decisions into lasting wealth. In the end, the path to lasting wealth is not complicated, but it is demanding in a different way. It demands restraint instead of excitement, patience instead of speed, and understanding instead of constant action. Those who succeed are not the busiest or the loudest, but the calmest and most consistent. They choose carefully, commit deeply, and allow time to transform good decisions into great outcomes. True financial freedom is built by focusing on quality, simplifying choices, and trusting long-term ownership. When noise is ignored and discipline is protected, progress becomes steady and predictable. The greatest advantage is not access to information, but the ability to remain rational when others are not. Wealth rewards those who can wait, who can hold, and who can stay clear-headed through uncertainty. When decisions are few and thoughtful, mistakes shrink, and conviction grows. Over time, this approach compounds not only capital, but confidence and independence. What begins as patience slowly becomes momentum, and momentum eventually becomes freedom.